But everyone, I'm going to dive in. I'm sure Edmund will be joining us in just a second. So everyone, thank you to our event, which is over the course of this half day on the future of Chinese capital markets. Now, as fate would have it, through good luck rather than good management, later on this afternoon, probably around 4 p.m. New York time, we're likely to hear from FTSE about whether or not China will be heading into its developed market into its global index. Our friends at Goldman Sachs are assuming it's going to be a 5.7% weighting. There'll probably be a 12-month grace period, and given that there are approximately $2.5 trillion of assets that are benchmarked to those FTSE World indices, that will be somewhere in the vicinity of $140 billion worth of bonds that need to be purchased at some stage over the course of the next several years. But what our event today is going to be focused on, or should be, it's going to be a continuation of a theme that a lot of us have been talking about over the course of the last 6 months or so, which is a global economy or an investment landscape that is changing at an unprecedented pace. So be it our obsession now with Zoom, our format of the day, be it our ability to deal with the demise of small business, we're facing unprecedented changes. And one of the changes which I think is most prevalent is going to be in the realization that developed market yields are going to be at zero for the foreseeable future, which exposes, or should I say, which promotes China as one of the last bastions of high quality yield that exists globally. So our conversation today is going to be involve the panelists here today, including Phoebe Leung, who's going to be representing the Hong Kong Bond Connect. Now, for those of you who are not aware about the Bond Connect is the infrastructure, the backbone, the plumbing that allows global investors to access domestic Chinese debt. We have Keith Berlin of FEG. FEG has been assisting clients with fund allocations for over 3 decades, and Keith runs the fixed income and credit portfolio or credit advisory over at FEG. David Loevinger, who is an MD of the emerging market group at TCW and a former Treasury official where he was the senior coordinator for China affairs, and Edmund Ng, who is the founder of Eastfort Asset Management, which is a Chinese fixed income fund looking predominantly at local currency bonds, and prior to that he was the head or the director of investment division at for reserve management at the Hong Kong Monetary Authority. So everyone, thank you very, very much for your time today. And Phoebe, I'm going to start with you, and I want you to give us a little bit of a background, or to set the stage over the size, scale of the Chinese bond market and some of the nuances surrounding investment in Chinese fixed income.
Thank you very much, Paul. It's my pleasure to join the panel today with all the fellow panelists. So for the China market, it has been occupying the attention of many international investors, especially in the past 10 years, when many of the foreign investors are now able to participate in the onshore China interbank bond market. So today, the China bond market has actually grown into the second largest economy in the world already, and in 2017, it has exceeded Japan and become the second largest bond market in the world as well. So for the China bond market, it is actually divided into 2 different markets. So one being the exchange market, which only have the 10% of the total market liquidity. And the second one being the China interbank bond market, which going forward, you will likely, for example, hear from me and Edmund calling it the CIBM. This interbank bond market contains all the the institutional investors, and it drives 90% of the total market liquidity. It has all the many bonds that investors have been looking into, like the CGB, the government bonds, policy banks, and even for some aggressive investors, the credit bonds as well. So in the last 10 years or 10 to 15 years, there have been a lot of different asset schemes that the regulators have put out. For example, the older quota systems, which we call the Q fee and RQ fee, and more recently, 10 years ago, for example, some central banks and some sovereign wealth funds, they have utilized the CIBM quota system to come in. Bond Connect is actually the latest asset scheme to actually introduce all the different international institutional investors into the onshore market. And very interestingly, what I'd like to highlight to our audience is that when we were approached by the PBOC in 2015, we were actually given a task to expand the international participation from back then below 2%, around 1.6%, into 15% in the next 5 to 10 years. So what can we facilitate it, and how can we facilitate it is by designing an asset scheme that actually allows the ease of access, be it trading or settlement and custody for international investors. So maybe perhaps later on, if I have the chance, I can also explain how the Bond Connect works. But essentially, we are the scheme that is leading all the international investors into the onshore China bond market. And at the moment, we're running at about 2.8% international participation, and we're likely going to be looking at more as more enhancements are being brought about into this kind of asset schemes.
Right. So thank you, Phoebe. So David, I've made the point, and we made the point on a previous conversation that we had, that at the most basic level, this is how I view the Chinese bond market, that it's the world's second biggest economy with the world's second biggest bond market that isn't truly represented in global bond portfolios. Where I think you might disagree with that point to some extent, but where am I wrong with that statement, and where are Chinese bonds underrepresented?
No, I think you're right, and it's an important point. I think investors need to know that they are going to be holding a lot more Chinese assets in their portfolios over the next decade. China has been opening up rapidly, as Phoebe has been talking about. Foreign investment has been pouring in to both equity and fixed income markets. There's a lot of reasons for that, but I think the most important reason is China is in the process of being included in all of the major equity and fixed income indices. Some analysts have called China's index inclusion as the financial equivalent of China's WTO accession. The fact is that global investors are massively underweight Chinese assets, as you pointed out, and that's going to change rapidly. We've been increasing our investment in Chinese assets a lot this year. There's a lot to like about investing in China. You mentioned yield. We're in a world where zero is the new positive. Actually, zero is not that bad. 25% of investment grade sovereign bonds have negative yields. So if you can get 3% on a A-rated sovereign, that's pretty good. As a dedicated emerging market investor, what's attractive to us is not just the yield, but the volatility adjusted yield. So both Chinese bonds and the China's exchange rate is a relatively low volatility asset. That's particularly attractive to us in a defensive context. So we, as a dedicated emerging market investor, we see Chinese assets as being attractive in a more kind of defensive environment. There's lots of other advantages. China provides a lot of diversification benefits. a lot of markets that we invest in are tied more to the US or European economic and credit cycle. China helps with that. Obviously, China's a market, as you say, second largest bond market in the world. China's a market where you can trade in scale, and there's lots of liquidity, particularly if you stick to on-the-run issues. And lastly, you know, China has some pretty strong fundamentals, which we think justify its single A rating.
And does that apply not only to dedicated funds but to crossover funds as well? Where does China have a role in crossover vehicles?
Yeah, so I think the difference is the main attraction for crossover investors is one, the yield, because you know, given that 25% of investment grade sovereigns have a negative yield, and you can get 3% out of China. It's the diversification, it's the scale. For emerging market investors, when we're bullish fixed income, we want to be in higher beta markets, Brazil, Indonesia. It's when we want to get defensive that China becomes particularly attractive for us.
Got it. Got it. Now, Edmund, I'm not sure if you can hear us, but I'll dive into your first question.
Can you hear me?
I can hear you, Edmund. I'll need you to get a little closer to the microphone, and we can hear you. Yep.
Yeah, I don't know why I cannot connect to the video. So I'm sorry.
That's fine, Edmund. No problem. So, Edmund, what in terms of China's or Chinese fixed income's role in terms of asset allocation and portfolio construction, can you talk a little bit about the evolution of Chinese fixed income, or more specifically where we are today, as Chinese fixed income being an essential part of any global asset allocation scenario?
Yeah, as a previous asset owner in my HKMA days, can you hear me now, Paul?
Yes, we can, Edmund.
Yeah, obviously we look at the asset allocation framework, and you know, since 2011, when we started when I started the portfolio in HKMA, already we are seeing a lot more features that can really justify the China bonds onto the global asset allocation framework. Now, for one, for example, is that the RMB is part of the you know, SDR currency basket. So I think this really facilitates a lot of central banks to be able to actually consider moving part of their reserves into RMB. Second of all, I think this is very important is that, you know, it's the second largest economy. I think that you guys mentioned that. And also you know, the bond market is the second largest. So to large asset owner, especially those with, you know, billions or trillions of dollars, you know, yes, there are other markets which might actually give you slightly higher return, but in general, you know, the investable universe usually is relatively small. So I would say that, you know, the second largest economy and the second largest, you know, bond market really, you know, give you the size and the scale. Then, of course, if you're talking about the sovereign credit rating of A+ by S&P versus, you know, most of the other, you know, for example, if you put it in a EM bucket, basically it would be the highest, you know, sovereign credit rating. Of course, in a DM is equivalent or slightly higher than Japan, depends on which, you know, credit rating agency you're looking at. Then to the, you know, as an allocator, the portfolio diversification is also very important because you don't want to have a high correlation. And we have done the correlation analysis in the past and currently. You know, we have seen that the correlation is relatively low against either DM bond market or the EM bond market, which give you the diversification benefit. Now, then another point about the volatility. Talking about the risk-adjusted return, China bonds actually give you a reasonable risk-adjusted return because of you know, the volatility. We look at even during the second quarter, you know, when the market was quite volatile, the CGB volatility was actually slightly higher than the JGB market only. So it gives you a pretty good risk-adjusted return over your, you know, your bond portfolio. So all these are really good justification to start to look at the China bond. Of course, I understand that there are some concerns about, oh, this is a new market, are they opening up? And you know, whether, you know, is it easy to get in or not. Now then, to really answer your questions about, you know how easy or you know, the access. it has actually made it much easier for the foreign investor to access into it. For example, the Bond Connect was set up in mid-2017. And in 2016, before the Bond Connect, is that they changed the quota system to a register system. So there's no more quota to really limit the size of, of your investment, and you can go in and out of the onshore market anytime you want. So all these features, I would say that at least the asset allocator or the asset owner should consider, part of their portfolio should have, China bonds on too.
Right. So Keith, for someone who, from your own admission, is not really an active participant in the Chinese bond market, you've heard a remarkably constructive story, right? So why don't you give us the skeptics argument, the rationale behind not investing in China? Because all I've just heard is a really high quality bond market in a world where a 5-year basket of global developed market fixed income gives you next to nothing, or gives you nothing. What's the skeptical argument?
I wouldn't say that we're against it per se, but I would say that as we think about our fixed income portfolios for our typical client, we're generally going to be more US centric in our exposures. To the extent that we use a global bond manager or a emerging market debt manager, someone like TCW, for example, we would put that decision in their hands. So maybe whatever that weighting is, if it's 5.7% of an index and they are managing to an index, we're comfortable with them having that exposure. There is some pressure, I'm not super worried about this, on endowments and foundations and so forth from the government to not invest in China. So that on the equity side, and that may present some challenges for folks on the fixed income side. I don't know if that's a huge deal today, but as we think about China, it's just another option within the overall spectrum of things that fixed income investors could consider. Will we be going, big time into China's debt market as a solution for the lower yielding opportunities in the traditional fixed income markets? I don't know. I think that it's something to consider longer term, and we'll see how it plays out.
Right. So Phoebe, I think one of the things that often spooks or is something that is disconcerting for global allocators who are looking at China, not for the first time, but looking in general, is what I describe as China has a bond market with Chinese characteristics, right? It's not your garden variety bond market. This is not the equivalent of buying bunds or JGBs or treasuries. It has a lot of nuance to it. It has a lot of complication to it. So why don't you talk a little bit about the structures of the market and alleviate some of the trading, the settlement and custody concerns that people have for a market that isn't your garden variety bond market?
Sure thing. I think traditionally why people think that China was a market that is, harder to enter, have higher barriers of entry is exactly what you mentioned. I think it's about trading, it's about the settlement and the custody. So that would actually bring me into, talking about, what the other traditional asset schemes are like. So for example, for China, it is still in a process of opening up and is still, in the middle of its RMB internationalization program. So, for example, traditionally with the CIBM agent model, for example, as Edmund has rightly mentioned, it is more of a quota system in years before, and there has been some repatriation restrictions that are involved as well. And for programs like the QFII and RQFII before, it may be subject to certain geographical locations investors as well. So with the Bond Connect setup, I think we have largely eliminated many of the barriers of entry. So for example, when we actually designed the way of trading, traditionally when offshore investors do any trading using their onshore agents, they can be doing, a trade on IB against their onshore market makers. However, they will need to rely on a bond settlement agent onshore, which is their onshore custodian, to key in all this kind of trading details into the onshore CFAX system for them, which is the onshore trading system where all the different fixed income tradings are being booked. With the Bond Connect scheme launching, we actually designed it on the basis that investors are able to use e-trading platforms such as Bloomberg or TradeWeb, or we do have some other third-party e-trading platforms that are going to join us soon. With the e-trading platforms, the investors can now actually be able to conduct RFQ trading against the onshore market makers, Bond Connect market makers, which are actually carefully selected under straight assessment by the different onshore regulators. So from this perspective, the investors are actually able to trade in how they trade in DM markets. So I think that barrier of entry is being eliminated. And so I think, with this kind of e-trading platforms being introduced, this would be able to guarantee, the investors having full autonomy, full control in the trade execution, and the speed and the accuracy of all the trade inputs as well. And the second element that I would be talking about would be, for example, on the settlement and custody side. So traditionally, second barrier of entry is the fact that the investors traditionally need to open all the accounts with a local onshore custodian, which I call the BS agents and the bond settlement agents. And with them, all the bond account, cash accounts are being opened onshore, which many of the investors may not be entirely comfortable in. And with Bond Connect, the investors are not required to open any accounts in China for their holdings. And instead, they actually own all their CIBM bonds through their global custodians. So the global custodians are able to use their existing global multi-tier custodian framework when trading in Bond Connect. And so the Hong Kong CMU actually has a centralized nominee account being opened in the onshore depositories, which is the CCDC that clears all the rates bonds, and the Shanghai Clearinghouse that clears all the credit bonds. So the CMU effectively, which is part of the Hong Kong MA, Hong Kong Central Bank's settlement unit, the investors are able to enjoy full beneficiary ownership without physically opening this bond accounts in onshore. And having the global custodian framework will actually also allow the investors in opening all the cash accounts in offshore rather than in China. So at no point in time will offshore investors have any cash exposure in China, which will also eliminate any tax implications. Now, this is actually surprisingly very important to many of the offshore investors because, they don't need to worry about any potential repatriation issues anymore. So effectively, this makes Bond Connect a more direct, easier and faster type of access route for the investors. And I think the third and last point that I want to address is actually the action of entering the market itself, the registration and the filing. So traditionally, when offshore investors need to want to participate in the China interbank bond market, the registration process in the traditional schemes have actually taken some investors for months of time, even half a year to 1 year for like CIBM agent model or the RQFE systems. For Bond Connect, the investors are actually able to complete all their filing between 2 to 4 weeks time because we have the e-filing system and we have Bond Connect company like ourselves to actually tell the investors what exactly the KYC details are that PBOC is looking for. So I think in short, many of the barriers of entry that is related to the structure of the China bond market, how it allows offshore investors to enter this market specifically, has largely been eliminated by the establishment of Bond Connect and the way that we designed the whole architecture.
David, Phoebe puts forward a very, very compelling argument about how this is it's a nuanced bond market certainly, but it's a relatively seamless one. As an emerging market manager, you've been dealing with settlement issues in complicated markets for many, many years. What are some of the improvements that you would like to see, and what are some of the challenges that you face from a sales and marketing perspective, convincing skeptical clients that this is a bond market that is safe and secure when compared to developed market equivalents?
Yeah, so I'd say a few things. So, on our wish list is some clarity, long-term clarity on tax treatment. They agreed to temporarily waive the withholding tax on interest from policy bank bonds, and a lot of foreign investors are in policy bank bonds. Some certainty on that would help us. We're not having problems with settlement issues, and Paul, I would say most of the questions we're getting from investors is how can we get into China these days. I think Keith is right. Like a lot of asset owners, they see worsening U.S.-China relations, but they're worried more about how do they get the yield and growth in capital to meet their long-term obligations. I wanted to talk a bit more about the risks we see about investing in China, because there are real risks, and I'm going to mention 3 of them. So one is poor data and policy transparency. I don't understand how China can do so many incredible things. I mean, build out a high-speed rail system across the country and still have such poor quality data, particularly for national income accounts and for its fiscal accounts. Also, even though China has made a ton of progress in the last 10 years, they are way behind, not just developed market, but emerging market counterparts in communicating with and guiding markets. Just think about what we've been through in the last 2 weeks. Like, foreign investors were trying to figure out whether statements by 2 former PBOC officials represented a change in exchange rate policy. That's ridiculous. Like, China should have a spokesman who speaks regularly. PBOC should have a spokesman who speaks regularly about monetary and exchange rate policy, that investors know when that person speaks, they're representing the Chinese authorities. I have to be honest that a lack of free expression and the lack of kind of independent news sources is a big risk of investing in China. I mean, for us to be able to make investments, we need to know what's going on. So data is part of it, but people being able to explain to the rest of the world what's going on is critical for us. And I have to say, these concerns now are extending from the mainland to Hong Kong. Rating agencies, it's great. We're very excited that rating agencies now, the global rating agencies, will be able to operate fully owned subsidiaries in China. Chinese rating agencies have no credibility for most foreign investors. But the question is, will rating agencies be able to call it as they see it in China? And actually, will they be able to have a viable business model? Will Chinese companies be willing to pay for, let's say, less friendly ratings than is currently the case? And the last, I think, big risk for us is credit risk. I think it's important to note foreign investors right now in China fixed income markets, are almost entirely in 3 assets: government bonds, policy bank bonds, and AAA negotiable certificates of deposits of kind of the biggest and most creditworthy banks. Onshore, foreign investors are unwilling to take credit risk. And I think there's a number of reasons for that. One is the pricing of credit risk has been distorted by explicit and implicit guarantees. The regulators are trying to pull back these guarantees, which is the right thing to do. But the fact is, in the years ahead, investors are going to wake up and realize that credits that they thought was being backed by the government are not going to be backed by the government. And the process by which that happens, I think, is very opaque. There are going to be more defaults given China's level of indebtedness. I always tell people more defaults in China is a good thing. That's what happens in normal economies. There haven't been enough defaults. But I do, have to say, right, the bankruptcy system in China and creditor rights, particularly foreign creditor rights, still remain very untested when we get into a credit downturn.
David, the point I would make about all of those, and all of those are incredibly valid points. And if you and I were sitting back having a conversation in 2012, we probably could have been having this exact same conversation about credit quality and rising default rates and immature bankruptcy laws and all these things. And frankly, a lot of this stuff hasn't really changed. So the question I would pose to you straight back is this just China being China? Is this, the joke I often say to people is that Lehman Brothers would still exist if it was a Chinese company, and it's solely because of different accounting standards. So, I mean, are these the nuances that we need to deal with? And frankly, have we as foreign investors overestimated the risks that you've alluded to because China's just China?
Yeah, so I mean, Paul, I agree with you with the China's just China part. What I'd say is compared to 2012, China is so much bigger and has such a bigger impact on global financial markets. And China is a much bigger part of investors' portfolios today than it was in 2012. And it's going to be an even bigger part of investors' portfolios. So the fact that Chinese policymakers are so bad in communicating with markets is a much bigger problem for global investors today than it was in 2012. China's level of indebtedness was high in 2012. It's much higher today. Trees don't grow to the sky. At some point, China's going to have much more kind of distress among debtors, and we don't know how it's going to play out.
Edmund, I'm going to get you to first and foremost respond to some of the points that David brought up, but then I want you to sort of to take this risk discussion to another level and talk about some of the what I call market deficiencies. And by market deficiencies, it's issues over the absence of a repo market, asset swaps not being as easy as it could be, complaints over the necessity to use over third-party FX transactions and the like. So first and foremost, why don't you respond a little bit to David's points, and if you have a different point of view, but secondly, then start talking a little bit about the market nuances and the like, and some of the deficiencies there.
Yeah. Okay, Paul. First of all, to respond to David's last point about credit risk, I don't disagree with him, and that's why, for example, my fund actually do not invest anything that is not rated by S&P or Moody's or Fitch. And secondly, from a pricing perspective, he is also right in the sense, if I buy Sinopac or CNOOC on an asset swap basis, if I could actually do as a swap onshore, when I compare the US dollar, Sinopac and CNOOC versus onshore asset swap, the offshore is, in dollar is always 50 or 75 basis point higher. So taking credit risk onshore, to me, is expensive or relatively expensive than offshore. So I don't disagree with him. And secondly, is like a lot of this default, and which he point out, is that it happens since 2014. Before 2014, there was no credit default in China. And since 2014, because the government or the regulators really want to push for a more internationalized type of bond market. So they started to allow a more controlled type of credit default cycle. And because of that, there has been a credit differentiation cycle in China. And that's the reason why that for us, we actually take much less credit risk. We prefer to take actually more liquid market risk, because durations, the FX and spreads and the curve, you can still make some money or generate return rather than taking the credit risk. And he was right in saying that it could be AAA rated by a Chinese credit rating agency today, and a week later it could be a single B. So I think that we want to avoid that. But I must say it has been improving. As I mentioned, there was no credit default before 2014. Now we have a lot of credit default. And this cycle will continue in the next few years. And before the cycle completed, of course, we have to be very, very cautious about taking credit risk. Now, then going to his second point about the International Credit Rating Agency. Now, first of all, I'm on the S&P International Investor Panel, specifically on China. And we have been really promoting and facilitating the onshore S&P, 100% owned by the S&P, to provide the credit rating on Chinese company. Yes, he is right about it's still too early to say whether they will be successful or not. They only started in last January, and they have come up about 50 names on onshore under the S&P rating model. And I think that it will take them another year before that they can have a pool of maybe 400 to 500 names. But before we can see the output, I must say that this again is a big step ahead as compared to in the past, that only the onshore Chinese credit rating agency could actually provide a credit rating to the Chinese company. Or that the Moody's have a joint venture, but they are only 49%. So, again, they're not the majority. So I think that at least I must say that there has been improvement, there has been enhancement, and certain transparency has become better than, let's say 2 or 3 years ago. But like what Phoebe mentioned, like what you mentioned, this is an evolving market. This is not a DM market. This is an EM market, and credit risk, that is not at the same level as some of the DM market. We have seen that everywhere. I have gone through the Thai baht crisis, the Asian crisis back in 1997. Some of these MDX or FIN1 were also AAA, and then a week later it was actually defaulted. So we have seen that happen, and this movie play it again in many countries. So it's just how we can avoid it, I think, is going to be key. Now, going to his first point, again, I don't disagree with him. Why? Now, first of all, even the government realized that there was a problem. In the past, too many different regulators. You have CBRC, CIRC, PBOC and SAFE, and CSRC. And they were not so coordinated in the past. And so someone from CBRC could be saying something as compared to someone saying something in CIRC. So in this case, that's what they actually formed a task force, and they combine and become the CBRC now. So the two regulators and emerge. And on top of that, they have this committee to really coordinate among all the regulators. So in this case, I must say that it has improved, in my opinion, in the last 5-6 years. But of course, one thing they haven't done very well is exactly what David actually mentioned. It is really how to communicate and articulate what they want to do to their foreign investor. But you have to understand, the regulators onshore have always been dealing with onshore banks, onshore entities. And so they have not been able to really face the foreign investor as much as now. So in this case, they are getting used to it. And on top of that, many of the announcements that they make is always in Chinese, and sometimes they don't even have a translation a day or two later. And that really is not a good transparency policy, but certainly I think they are trying to enhance that process, but it would take time. And that's why I think, that's the reason I don't disagree with all the points. It's just that I would say it would take time because this is a new market which just opened recently, about 3 years ago, to the rest of the world. And so the world has learned about this market. Same as the regulators onshore have to learn more about what the what the foreign investor want. For example, we could not hedge the onshore FX in the past. We could only hedge it offshore. now we are able to hedge it onshore, and that means more stable and cheaper kind of FX hedge. Secondly, we were pushing for them to allow foreign investors to use Easter to conduct derivatives onshore. They were pushing back for 2-3 years, but we were fortunate that since last Friday, the CFED announced that we are the first foreign fund able and to be allowed to use Easter to conduct onshore derivatives. So in this case, I think they are listening. It's just that, you know, depending on how you put it in front of them, at the same time is that you have to tell them what are the advantages and disadvantages and the reason why the foreign investor are demanding it. And these are reasonable demand. Now, then, of course, I want to direct to your next question is about the market deficiency, such as why they don't have repo offer to the foreign investor. We have been trying to tell them that, you know, in their lens, they're looking at repo as a way of providing leverage. But I would say for a lot of international investor, this is a tool to actually manage liquidity. So for example, you have 1 billion going out this week, but you know that in the next couple of weeks, you will have 1 billion coming in. Without repo, the only thing that you can really do as a manager is to sell 1 billion of bonds, get the cash, meet the redemption, and then wait for the money to come in and buy again. And that will actually cost a lot in and out transaction cost, you know, NAV hit. But you can do repo, then basically you can just borrow. So they accept that and they say, oh, is that right? You know, this is actually more for liquidity from international investor perspective rather than onshore. They use repo as a form of leverage. So I think that is just a different kind of perspective, but I am pretty sure that they are listening and they will be able to allow repo for the foreign investor going forward. Just as that they allow us to use Easter, and I'm sure that many other foreign investors would be able to use Easter to conduct the onshore IRS or onshore derivatives. So I hope I answered the question. For SS swap, I agree with you. They have to build the term structure because onshore, the swap curve only go up to 5 years and not 10 years. But then the bond side is actually up to 50 years. So unlike in US, unlike in Japan, unlike in Europe, that you can do your SS swap, but in onshore, you cannot do the actual SS swap. And that, I think, to international investor will not be ideal. And that's why I think the onshore regulators are also looking at it. But of course, they have, you know, maybe too many priorities. They need to prioritize which one will be delivered. And I think that the repo will be one that probably in the next few months to a year, they will be able to deliver. So I hope I have answered all your questions.
Yep. So David, just take that point. I think you might have something to say, comment on that, but talk a little bit about the benefits of repo for your business.
Yeah, actually, we don't do repos in our business. We mainly take long positions in Chinese bonds, and we do some hedging on foreign exchange. So it's really not relevant for our business.
Got it. And what about development of derivative markets? Is that going to enhance what you're able to do?
Yes, to a certain extent. So, you know, we look at kind of rates and FX separately. Even when we invest in bonds, sometimes we do it because we just like the rates position. We want to hedge FX. Other times we'll want to just take an FX position, hedge the rates exposure. We may use derivatives a bit more actively in less liquid markets, but again, as an emerging market investor, China's a pretty darn liquid investor. So Paul, honestly, you know, given what we can do both onshore and in Hong Kong, it just hasn't been a problem for us.
Got it. So Keith, you've heard a pretty compelling story in the last over the course of the last 40 minutes, and for someone who is, you know, not as engaged as China in portfolios as other dedicated vehicles. Let's talk a little bit about what you're seeing from the US-China. I'm not going to call it a trade dispute. It's a recalibration of the entirety of the economic relationship, right? what we're going to hear today is, potentially we're going to hear FTSE adding China to about a 5.7% weighting to its indices. Is it a fait accompli for you to invest in the global funds or encourage your managers to go straight to benchmark? Or is a deterioration of the economic and political relationship between the United States and China, is that cause for concern for you?
I think the way to think about a lot of these risks is to think about what is the right risk premium for those risks to get us excited. And so you said, what have I heard as an asset allocator over the last 40 minutes? I haven't heard anything that made me super excited. David listed off, I think, 10, 12 different risks of things to think about. So the question I would say is, on the one hand, we're talking about a risk return, risk-adjusted return that's pretty compelling, but what does that actually yield, like 4 or 5%? Is that risk premium over a comparable treasury worth taking that risk? And if you think about it from a fixed income portfolio that's already pretty well diversified, adding China in some incremental way, it's not really going to move the needle much one way or the other. And it kind of brings it back. So would we start taking a dedicated direct allocation to China at the asset allocation level? Probably not for a good while. But would we allow folks like David and other emerging market and global bond managers to consider those things within the context of their portfolios? Yes.
Got it. So David, I'll jump back to you on this question, and it's something that is being sort of front and center for me for many years. Well, at least the last 5 years. And Edmund, I'll push back to a point you made about renminbi inclusion into the SDR, because I don't think I've ever met a manager or anyone who's actually bought an SDR. That this was an incredibly symbolic measure by the IMF to appease China and bring China into the fold. And practically, it really doesn't do that much. And I would make an argument that China has been on this path of a closed capital account really since their inclusion into the SDR. It is a very, very closed capital system. If you were to ring up an American corporate in China, like say Starbucks, for example, they will tell you just how difficult it is to get approval for a $10 million foreign exchange transaction to get money out of the country. So I make the argument that China doesn't really want to have the renminbi to be internationalized, because there's a bunch of benefits in terms of efficient capital allocation and the like if you do have a free floating international currency, but there's also a lot of negatives, and those negatives are that foreigners can sell your bonds, and this is where I think the comparison to Japan is a good one, because the reason Japan has never had an economic crisis, when folks like me have predicted 9 of the last never financial crises in Japan, is because when JGBs are held 95% domestically, there's not the level of offshore liquidity there to create a systemic risk. So I'd like both David and Edmund to discuss that point and put it in the context for China to be a dominant part of global bond indices going forward. Does it need to have an open capital account?
Okay. Yeah. Paul, let me just answer first question about the SDR currency. Now, if I look at, first of all, when I was in HKMA, we were the first one as basically, investing into these China bond, even before the SDR, currency was being assigned. Now, after that, in fact, you are right. If you are talking about just normal asset managers or pension funds or insurance, they might not be allocating or investing according to SDR. But as a reserve manager of a central bank, they probably can, and it might not be 100% according to their ratio, but certainly that means you give them an option to do so if you are willing to. Now, and from the facts, and I think that Phoebe, you can jump in because you have all the data. I think since 2011, we have seen that the inflow has been about $100 billion US into onshore, because it's a foreign ownership data that they have. and it has actually increased to about 300 billion now. Now, I would say most of those inflows are actually central bank money. So you might be right that, for example, like Keith or like David, they might not need to actually allocate to RMB or China bonds. But I must say that the data should reflect that the central banks of the world, they have already started to do so. Now, obviously, this is a tier one of the institutions. So for a country, when the central banks start to allocate, it's very likely that it filtered through to tier two, which is the pension or the insurance or the other large corporate. I'm not saying that they would just put in 10% right away, but that only means that they have an option to look at if my central banks are actually investing into the China bonds, maybe I should look at it. So that's why I think that this has been happening in the past few years, alongside when the PBOC or the regulators onshore have been really liberalizing the market a bit more and easier access. So I think that you're probably right that the private managers will not look at SDR, but the reserve manager will certainly look at the SDR, but just that they don't need to invest according to exactly the ratio. Now, on your second point about the capital account, according to what I know, within the capital account, there are only 3 items that are not actually open. And it's more for the onshore funds coming out is because if every Chinese populations actually come out with 50 or 100,000, it would be a big pressure to the regulator or to the reserve. So they might want to do it very slowly. But as far as I can see in my position, for example, once that they allow me to invest into onshore through the register system, not a quota system, I go in and out. I have been really investing in and out on a regular basis. And there was no question asked, even though my fund started only in mid-2016. And you remember in 2016-17, there was a big drain of the reserve for about $1 trillion. Even during that time, I had no issues when I actually sold the bonds and took the money out. So maybe the corporate will have a slightly different experience. I don't know, I cannot speak for them. But certainly I can only see that from a portfolio flow in perspective, that seems to be very smooth. And I think that Phoebe can also comment a little bit because they are seeing that the northbound flow, southbound flow from China into China on, not just on the bond side, but, since that she is in Hong Kong X, she should be able to comment also on the stock side as well.
David, any thoughts there?
Yeah, so let me just pick up 3 things. So one on the SDR, investors don't care whether China is or is not in the SDR. Being in the SDR doesn't make a currency a reserve currency. Tens of millions of investors have to decide whether they want to hold yuan assets. That's what makes a currency a reserve currency. What the SDR was all about was a pretty a cagey political move by PBOC Governor Zhou to kind of use the SDR as a way to get political approval for a whole set of financial and capital account reforms that has kind of really opened up China. Yes, China isn't as open, its capital account isn't as open as Japan's. But compared to 10 years ago, it's the difference between night and day. I mean, Phoebe wouldn't have had a job. She would have had a job, but at a different place 10 years ago. And certainly we wouldn't have all the investments we have today in China 10 years ago. And the direction is very clear. But I would put it differently. I wouldn't say it like, does China want the yuan to be a reserve currency? I would say, does China want to promote the use of the yuan in settlement of trade and financial transactions to a much greater extent in the years ahead than is the case today? Absolutely. And, there's 2 reasons. U.S. companies have a huge advantage that the dollar is the primary currency for settling trade and finance. They can do most of their transactions in their home currency. We saw what this advantage meant back in February and March, when there was a mad scramble across the world for global liquidity. And the companies that, were in the best place were US companies, because the Fed could most easily, just provide dollar liquidity to the US banking system, and the US banking system could provide dollar liquidity to US companies. There were kind of Fed swaps with other companies, but there was a much bigger scramble for dollar funding overseas than there was in the US. But I think there's a much bigger geopolitical issue for China. China, you talked about the changing relationship between the US and China. China sees much bigger risks going forward. It's very clear to China that it has two big vulnerabilities. One is in technology, in core technologies, and the other is its vulnerability to financial sanctions from the US and being cut off from settlement of both trade and financial transactions in dollars, being cut off from the US financial system. And I think a couple of years ago, the concern was the US might target particular bad actors for trading with North Korea or Iran. I think the concern much more now is the US could use financial sanctions as a way to destabilize and weaken China. So my sense is there's a much greater urgency to set up systems where China can trade and invest and bypass the US financial system.
Right. Phoebe, we have about 60 seconds, so I'm going to leave the last word to you. As that vehicle, as that very China with Chinese characteristics, the Bond Connect is uniquely Chinese in the way that it handles settlement of bond transactions. What are we likely to see from your organization over the course of the next 5 years?
Okay, sure. Thank you for the last question. It's very precious indeed. So actually, in the next short to medium term frame, there are actually quite a couple of initiatives that we are looking into. Recently, in many of the public forums, we have actually mentioned that the times of index inclusion, that has already sailed, the boat has already sailed, because now we're actually, trying to focus on more of the initiatives that would really drive, the technology changes, or for example, derivatives and introductions that are required to really achieve RMB internationalization. So, in many recent forums, we have done some surveys on what are the key derivatives that investors will need in order to facilitate more of their investments into China. In 2020, the ADT that we have seen from international investors have actually already doubled from last year. So now we are seeing at around 20 billion RMB a day on average. And since on Monday, when we extended our trading hour from 4:30 p.m. to 8 p.m., which is going to extend further in the future, we are seeing close to 30 billion RMB trading in one single day. So what needs to drive this even further? For example, the introduction of bond futures is the one thing that many of our investors need, and this is something that we are still working in the pipeline, because this is actually what is only being offered in the exchange market. Not many offshore investors are able to trade in that, with the exception of Edmund's Eastfort fund that is already being able to access the futures market. But this is something that we definitely need to drive. The second thing is third-party FX. So third-party FX, it has already been announced today that offshore investors can hedge their FX needs with multiple FX counterparties. So that is being solved. The next thing that I think we would need to be driving would be, for example, IRS. Repo, as Edmund mentioned, and very importantly, primary market access. So please stay tuned to Bond Connect. We're likely going to bring up this kind of initiatives in the near future.
Thank you, Phoebe. Thank you, Keith, Edmund, David. Thank you very much for your time. I must jump to the next panel. Thanks so much.
Thank you.
Thank you very much.
Bye.